Assalamu alaikum. Welcome everyone to Mayar Capital annual meeting. I'm delighted to be the moderator for tonight. My name is Nadia Shabmasi. I'm a professor of finance at King Fahd University of Petroleum and Minerals, and I'm honored to be the moderator tonight. Let me start with the agenda for tonight. We'll start with an opening remarks and welcome from Aziz. Then he will present the performance update. Then we will have the guest speaker, Mr. Richard Wiggins. Then we will have time for Q&A, and then we will have closing remarks by 7:45 to 8. Inshallah, we will be hopefully done. And I would like to invite Aziz to give his opening remarks. Tafadhal, Aziz.
Thank you, Naji, and thank you all for coming here today. It's always exciting to meet our investors, our partners who have entrusted us with their capital that we view ourselves as fiduciaries and try to grow and protect over the long term. It's exciting to do it also in Khobar. We, as you all know, we did the London one a couple of weeks ago. As our investor base expands globally, having to do it in multiple locations is going to become more and more important. But obviously, Khobar being our base, it will always have a special place in my heart, and the investors from here have been the earliest, and while we want to treat everybody equally, the earliest investors are kind of more important. I'd also like to thank the Mayar Capital team. My job is fun, exciting, because of them. They make what I do every day more enjoyable and more productive, and they help me achieve what we all set out, both us as your managing partners and you as our investing partners possible. And I'd like to thank our advisory board and boards of directors for their guidance and their support, and our partners in Apex, Jefferies, Northern Trust, KPMG, Conyers, and AFOS for supporting us day in and day out. We certainly wouldn't be able to do what we do without them. I also would like to thank Zamil House for hosting us here today and dealing with the arrangements. They've made the process seamless. And so for the second year, we have it here. We had to move to a bigger room this year as the number of attendees has grown. So I'm going to go through performance very briefly for the fiscal year that ended in June 30th. Then I'm going to talk about some changes that have been done since then, including an update on performance. Then I'm going to send it back to Naji to welcome our guest speaker. I'm really excited to hear what Richard has prepared tonight. And I'm sure everybody's going to learn a lot from it. And then we're going to go to Q&A. In the Q&A part, we're going to do what we always do, which is some of you have sent in their questions beforehand. Thank you for doing that. Really appreciate it. It helps us prepare some things and slides to answer some of the trickier questions. I don't have the rest of the team with me here today, so unfortunately I will still have to answer the harder questions instead of throwing it to them. But we'll do one from prepared questions and one from the floor until we're done. We're going to target 7:45 or 8 for a finish. Compliance makes me put this up. I'm sure nobody can read it, but it's up there. We always talk about success, but it's very important to remember that success cannot happen without a deliberate effort in building things and in building them on a foundation. And we've always believed that the foundation for everything that we do is in three pillars. The one most, and in my opinion, the most important one is what we call our partnership principles, and the second and third being strategy and process. Now, when we talk about partnership principles, which is essentially the constitution of Mayar, we talk about four essential things: speaking straight, in it together, only long term, and being risk averse. And the four shape both our selection and application of our strategy and how we go about building, implementing, and executing our process. Now, a quick reminder on what we're trying to do. We are trying to find businesses that meet our very strict quality standards. We're going to look for them everywhere in the world. And then we're going to buy securities that the companies owning these businesses issue. And if we don't overpay, we believe that we're going to end up with a very attractive risk-return profile. And that is based, implementing it is based on what we think is a very rigorous checklist-based investment process. And the reason we've always believed in having investment process that's checklist-based is that investing and investors are fallible because we're all human beings. We are biased by our psychology, and our decision-making will be flawed unless we use tools to overcome that. And the tool that is most successful in complex situations that are emotionally charged, such as investing, have been most helpful by the use of checklists. The other thing that's good about checklists is that when you make a mistake, and we will obviously make mistakes from time to time, a checklist gives you a feedback loop to look back at your mistakes, see what you could have done differently, and incorporate that back into your checklist process so that you don't do the same mistake twice. All right, let's talk about the fiscal year. So, for the fiscal year that ended in June 30th, 2008, before performance fees, the fund was up 13.2%. After performance fees, it's net of 12.95% against an increase of 11.09% for the MSCI. This brings cumulative performance since inception to 109.32%, 103.34 net, compared to an increase of 80.73 for the MSCI. Our top 10 positions at year-end, which I'm sure you've seen in the annual report, are Essential. Essential is a media company. The biggest product in Essential is WGSN, which, I mean, it's been described as the Bloomberg of the design and trend industry, but what it really does really well is collect and forecast trends on colors, themes, and that impacts everything in the design, media, fashion, and retail industries. So that's why you see people from Chanel to Starbucks subscribing to this $25,000 a user annual service, because if you don't have it, same as if you're trying to invest without having Bloomberg terminal, you are at a severe disadvantage. And that's been an investment that we've held for a couple of years. That's worked out very well for us. The second and third largest holdings at year-end are Microsoft and Alphabet. I'm going to talk about them in a minute because they've also been big changes since year-end. Nordstrom and Discovery continue to be in the top 10 and have worked fabulously well for us despite being very bumpy. And the rest of the list includes things like P&G, a recent purchase, but others that we've owned for many years, Unilever, Henkel, and MasterCard. Again, at year-end, this is what the geographic distribution of the portfolio looks like. Quick reminder, my preference in thinking about risk across geography is the first pie chart to the left, which is to look at things on a revenue basis. So instead of looking at companies based on where they're listed or where they're incorporated, what we do here is we look at every holding that we have. We look at the revenues of the underlying holdings, where do they come from geographically, then we essentially consolidate at the portfolio level to try to figure out from a geographic distribution, as owners of these businesses, which geographies are we exposed to at any moment in time. And we try to have it fairly diversified globally. And in the event that we are exposed to a geography in terms of revenue that is a lot higher than we think is warranted from a global GDP or global market perspective, then we have to think a lot about the risk-return situation in that specific investment. We continue to be diversified across industries. This will actually split more because of a new reclassification that's happening right now. So a lot of our companies are going to move from software and services, such as Alphabet, for example, into media. And this is what it's looked like over time. You'll see industries move, but we always try to maintain an element of diversification. The same thing with geography. One thing that I'd like to note here, which we talked about last year, it's very hard because of the scale here, but if you look at the top line there, this is the portfolio exposure by listing to North America, mainly United States in this case, and you see it peak in 2014 at 82.5%. When I spoke here last year, it was at a bottom of 42.5. It actually increased this year because of a couple of purchases and performance of the US side of the portfolio. We continue to find better value outside the US, but every now and then we'll find something, and just because we may think that a market overall looks expensive doesn't mean we're not going to take advantage of specific investments that look attractive to us. Again, we've put this before when we're looking at how investors view a portfolio. If you go on Morningstar and you see our style box, which they started publishing on us recently, you'll see them put us in the blend category. And we've been asked how we call ourselves or why we call ourselves value investors when our PE ratio seems to be identical to the markets. And the reason we do is that we define value differently, which if we look at this chart, instead of looking at the PE ratio, we look at the free cash flow yield, which is the inverse of a price to free cash flow yield. And what you see here is that while on a PE ratio basis, our portfolio looks average, on a free cash flow basis, it's substantially better in terms of free cash flow generation. So while the PE looks the same, the cash generation capability of the businesses that we own is substantially better. And that, coupled with a below average capital intensity of these businesses, so we've talked about this before, us liking capital light business models whenever we can, you see a return. I mean, this the scale on the left really doesn't do this justice, but the businesses that we want to own are generate substantially higher returns on capital, returns on asset, returns on equity than the market. And that, coupled with the free cash flow generation, we believe leads to substantially better total returns over the very long term. And that's always been our definition of value, to basically try to pay average or below average prices to buy businesses that are substantially better than average. Again, quickly going through the trades that we've done during the fiscal year. You know, we don't do much, so this has actually been a busy year for us. The main big purchases, which we've talked about in quarterly letters, are buying Merlin, buying Kyushu Railway in Japan, L'Occitane, which is a French company but it's listed in Hong Kong, Brenntag, a chemical distributor based in Germany, and Procter & Gamble in the United States. We sold Scripps Networks, which then got acquired by Discovery. Nestle and Expeditors. Actually, we talked more about Expeditors couple of quarters ago because we were worried about a potential trade war and how that could impact global trade. It's unfolding in a manner that is unfortunately worse than we expected, and we think that markets are not properly handicapping the risks involved. And we also talked in this latest letter about selling Swatch, which has been a disappointing investment for us. Though the other company that we bought at the same time, Richemont, has done well for us. We've bought more Nordstrom, which has worked very well this year. Evertech, which is a Puerto Rico-based merchant acquirer and payment processor. That worked very well during this year. We started buying it a couple of years ago. It was, and then again, why you need to diversify. Puerto Rico was hit very badly by hurricanes last summer. Evertech has done a heroic job for its customers, went way out of its way, helping them get back into business. And we're very proud to own companies that do that for their customers. And that we bought more of it then, and it's worked very well for us this year. I mentioned Discovery earlier, and we also bought more Johnson & Johnson, a holding that we've owned since inception. We sold some Alphabet and some Lindy. Alphabet because of the risk, the regulatory risk that we were getting worried about. You'll see in a minute that we sold more as that regulatory risk increased and became even more prominent. And Lindy we sold because it's getting acquired by Praxair, and we thought that there's not much value left on it, though we still own a small position in it. So now let's talk a little bit very quickly about what happened since the end of the fiscal year. So the past essentially 2 months. This is just going to be until the end of August. The portfolio is up 4.65% net compared to 4.4% for the MSCI. That brings cumulative returns to 119% compared to 88.7% for the MSCI. Now this is where a lot of changes have happened. You'll see Nordstrom now being largest position. This has been purely because of a return. We haven't added to it since then. But it continues to perform well for us, and we think it'll continue to perform well. But you see Alphabet and Microsoft dropping from the top 10 as we've cut the positions substantially. We've also cut MasterCard and Visa. All of these have to do with Alphabet and Microsoft. It's a worry about valuation, regulation, and with Visa and MasterCard, it's driven by valuation. And the rest of the top 10 have just been moves because of the stocks moving. We haven't done any decisions there. The only new purchase that we did this fiscal year has been adding to Henkel, which we've owned for 6 years. We continue to believe it's very well run, and we see a lot of value in it. So that is going up in terms of size in our portfolio. And you see the impact of this playing into our exposure by industry. So you see IT coming down from 32 to 24% since the beginning of the fiscal year, and you see cash going from 10 to 16. It's gone a little bit higher this month as well. We continue to be conservative, but we continue to find some opportunities. When we were talking about cash this time last year, and there's a question about it that's going to come up later. I think this time last year we were at 18%. We went down to low single digits early in calendar 2018 as volatility came back, and that gave us the opportunity to redeploy capital. And it's, as you can see, it will come back up as valuations come back up and opportunities subside. None of it is the cash is being done from the top down. It's purely an outcome of our process where if we find more opportunities to buy than the ones that we sell, you will see our cash go down and vice versa. And again, because of the recent sales, you see our US exposure coming down from 54 to 49. I think now it's down to even 48. But again, this is not being done top down. It's just we'll follow and go to the geographies where we find the best value. So this concludes my prepared remarks. I'm going to send it back to Dr. Naji, and we'll talk later.
Thank you, Aziz, for the nice and informative presentation. Now we will listen to our guest speaker, Mr. Richard Wiggins. Prior to working in risk strategy for Aramco, Richard was a principal at Buck Consulting in New York and chief investment strategist at Citizens First Bancorp, where he was actively engaged at the board level in the strategic planning process for the bank. He is past president of the CFA Society of Detroit, Investment Analyst Society of Detroit. He is also a past member of the Council Examiners, which authors the Chartered Financial Analyst exam, and a senior grader for the Level 3 examination for 10 years. Please welcome Mr. Richard Wiggins.
Thank you for having me. My friend Yasser here invited me. I've known him for 6 years. His one piece of advice to me was don't be boring, like my normal lecture. So I'll do my best to not be boring, but I have to warn you that it's hard to do like a makeover that quickly. With regard to my background, so this isn't showing on here. I can see both halves. I wonder if the slides are going to work. I guess so. Like it's only showing the half. But anyway, so this slide, I wrote an article for Institutional Investor, and it's all whited out. You can't read it. But anyway, it challenged a number of the fundamental beliefs that people are taught in MBA programs and within the CFA curriculum. It was a good article. It went viral. But my point to you is that so I tend to be known within the industry for writing for Barron's and things, and I challenge these sort of golden calves, things that we're taught that we presume are true, but we've never really checked to see if they're true. And that has tended to make me somewhat unpopular with some people. And so here I got a letter from Goldman Sachs, and they're nice at the top, where they say congratulations. And they said the article was interesting and well written. But in the highlighted part, you can see it's sort of interesting. They ask me, so what are we supposed to tell our clients now that you've more or less told them that what we've sold them on is wrong? Which I thought was sort of an interesting thing to ask me. I'm like, it's really not my problem. And then they had this thing at the bottom, which I thought was interesting, where they wrote the rest of the article, the letter they sent me was like 3 or 4 pages, and it's sort of nasty. And they say at the bottom, they say, not for further use or distribution to the general public. And it just seems to me that if you write somebody a letter and it's sort of nasty, you can't really tell them, and you can't share this letter. I was like, but since they have a lot of attorneys, I'm not going to share the rest of the letter with you. But I just got a kick out of that. I was like, okay, well, I got your attention. Now this guy, are you familiar with AQR? Huge hedge fund, Cliff Asness. He publishes quite a bit. He's a billionaire. So Goldman Sachs sent me that letter and kind of kept it quiet. This guy sent a tweet out, and he says, the article says, and this is what I wrote in the article, I said, I get the concept, I really do. And he goes, no, dude, you really don't. You don't come within hailing distance of understanding, but you're arrogant and snide about it, so you have that. I'm like, yikes, that's pretty aggressive. And then he sent a couple of other tweets. And I showed it to my wife, and she said, yeah, you are arrogant and snide. No, thanks, hon. But after that, he published a piece of research. So I had said in this article, I said, there really is no small cap effect. And we were talking just in the lobby, and he articulated all the reasons that there's not. And since he had sent the tweet, within the investment community, everybody saw that. Like, I don't actually follow anybody on Twitter. I'm not very up to date. And so I had a number of friends and things that emailed me and said, hey, did you see this? You just got your face tore off. And I'm like, no, I didn't. But everybody else did. An institutional investor did as well. So then when he came out with this piece that admitted that there is no small cap effect, institutional investor chided him. They said, hey, Cliff Asness knows less than he thought because of the tweet that I just showed you on the previous slide. But what I thought I'd talk to you about tonight is some ideas that I had for the next article. And so over here, this is a little thing from II where they're talking about an upcoming article. and they refer to me as a allocator and hellraiser. That's because at Aramco you can't say that you work at Aramco. And so I thought I'd share with you some of the findings that I share in that article, and then my hope to make Yasser happy is that you find them interesting. And so I have just a couple of things that if you guys are investors, and I presume you all are, that you might go, yeah, that's interesting. I don't have any forecasts. I don't really believe in forecasting macro variables or targets for equities, but these are more enduring takeaways that should be, you know, permanent intellectual capital that I hope you'll find interesting and I hope will help you in your own investments. So the first thing I thought I would show you is how to beat an index fund. So your slides just showed that you're beating an index fund. And I'm going to explain it in one slide, 5 minutes, no math, you don't need a CFA.
Then we won't be able to charge it.
And that's a problem, and I thought about that, but I had to go with it, right? So this is a chart. So the blue line here, I guess I better stay by the podium, that's the S&P 500. And then that line that keeps changing colors on the bottom, that's a line that I had Ned Davis Research make for me. That is if you bought the most expensive stock in the Standard & Poor's 500 every time it changed. So like you know, the top stock now is Apple, as we all know. And so when Apple became the #1 stock, you bought it. Now then when it's not the #1 stock, you buy the next #1 stock. And so if you go back through time, you know, on the far left-hand side, the slides are a little overexposed, I apologize, but you know, at one point AT&T was the largest company, and then at one point Microsoft was the largest company, and at one point IBM was the largest company. But if you just kept toggling back and forth, you can see that the S&P 500 outruns this linked index fund. I call it the zero diversification index because it's one stock. I mean, two stocks would be diversifying, right? And you can see that it outruns it. So the takeaway would be what? If I got to beat an index fund, what do I need to do? Just avoid the biggest stock in the index. And right there, you've given yourself a huge tailwind that would propel you toward being able to achieve your target. So that's that. Now this is, I guess I should have slid this earlier as an illustration. So you can see how the components change. So in 1980, IBM was the top stock. In 1992, it was Exxon. 1999, it was Microsoft. And so if we go back, I'm just linking those so that you can see whichever stock was the #1 stock, that's what we bought. So, and then Apple started in 2013, and it's still the top stock. So now you know how to beat an index fund. So the second thing I thought I would share with you is how to be smart, which then when I looked at the title, I thought that was kind of nasty, so how to be smarter, since you're already smart. And I thought I'd share, so there's the mathematician Carl Jacobi who always advises, invert, always invert, and to tackle a problem, you know, look at it upside down, look at it backward. And that's what I was trying to do when I created that zero diversification index. One stock has zero diversification, and by buying the most expensive company in an index, it seems really backward, but it gives you insight into how you should build a portfolio because it tells you what I don't want in the portfolio, which is sort of the opposite of saying, I'm going to look for stocks to buy. When I got done with that exercise, it actually told me, no, wait, now I know which stocks I don't want to buy. And in fact, another example of Jacobi's invert thing is, you know, back during World War II, they were looking at, this is a bad example because it's American militarism, but they were looking at airplanes that made it back to the base, and they were trying to figure out where to put more armor on them. And so they were looking at the planes and going, okay, where did these planes take hits? Where are the bullets landing on the planes? And it was an analyst who said, well, wait a minute, it's the planes that don't come back that we need to be looking at. So any of these planes where they're hit, don't put the armor there because they made it back. So by definition, it's invert the problem, invert the thinking. And I think that's good advice. And so and that's an example of what I was trying to do here was figure out what I don't want to own matters as much as what I do own, okay? Lesson 3, and I think this is probably the most interesting thing I have tonight, is that the most important thing that you need to know about stock market investing. I don't know if you guys are very participatory. Does anybody want to throw out an idea as to what you think the most important thing to know about investing in stocks is? Anybody? Abdulaziz, Yasser, help me out. Nobody? Nobody's gonna. Pardon me? Diversify. That's not bad. Okay, I like that. Diversify. It's most stocks stink, is in my opinion the most important thing to know. And this is new research, but the majority of common stocks that appeared in the CRSP means the Center for Research in Securities Prices. That's at the University of Chicago, where Fama French used to be. French is now at Dartmouth. But that's the oldest stock database in existence, and it goes back to when a bunch of professors tried to figure out what have stock returns earned since the beginning of time. So they were looking at the Cowles Index, or going through old newspapers back when there used to be a stock exchange in Philadelphia and all these different towns that used to be so large in the day. And in a nutshell, so when you say the CRSP database, that's the biggest stock database in the world. That's what I'm trying to convey. So what I'm saying here is that since 1926, and that's a long time ago, the majority of common stocks have a lifetime buy and hold return of less than 1 month treasuries. So think about that. We've all learned that there's an equity risk premium. We all know you win by buying stocks. We all know that that's why we play this game. That's why people are in this room. And then we flash the slide up there that says the majority of common stocks earn less than treasuries. It just can't be. It's true, though, and I used to be an equity manager, and it resonates with me because, when I looked at this stat, the median life of a common stock is only 7.5 years. And when I thought about that, I'm like, yeah, that's true, because you know what? General Motors is still, we just don't think of companies going bankrupt, but they do. General Motors, it's still here. Yeah, but it went bankrupt. Chrysler, it's still here. Yeah, but it went bankrupt. Northwest Airlines, been bankrupt. Some airlines that are gone that we don't see anymore. Pan Am, obviously not there. Blockbuster Video, gone. We used to have a fast food chain called Boston Chicken, Boston Market. It's still there. McDonald's owns it, but it went bankrupt. And I think about all the little clever, tricky companies when I was an equity manager where I was like, okay, video conferencing. And I'm like, I don't know which video conferencer will make it, but I'll buy all three. I'll buy PictureTel, Compression Labs, and I can't remember the third one. They all three went bankrupt. In the end, Cisco took over that space. So this gives some insight, why most companies earn less than 1 month treasuries if they only last 7.5 years or less, okay? What's particularly interesting is that the best performing 4% of companies explain the entire net gain for the US stock market since 1926. In other words, when you're an active manager, and people always think, okay, so I should have titled the speech, How to Beat an Index Fund. Why is it so hard to beat an index fund? It's nearly impossible to beat an index fund because only 4% of the companies end up contributing returns. So your 96% of the stocks that you choose from is probably going to whiff on them, okay? These are the companies, and this was research done by Henrik Bessembinder, and it's a new study, so I presume most of you aren't familiar with it. So these are the companies that have delivered all the returns, and you can see, so ExxonMobil, it started in 1926 that it kicked in and started delivering returns, and you can see its life has been 1,086 months. If you go to Apple, it's a good example beneath it. It delivered a little over 2% of the total returns to the stock market, and it only started in 1981, so it's been there for 432 months. But when you look at that list and you think about it, you're like, yeah, I guess I can kind of see that. It's the Johnson & Johnsons of the world, it's the Philip Morrises of the world, it's the Googles of the world, Procter & Gamble, Netflix, Amazon. Stock market return history is pretty much written by the winners, and there's just an inordinate number of losers. And that's one of the reasons it's so hard for active managers to beat an index fund. This is actually the cover of it, in case right now you're thinking I'm a wacko, but I told you in the beginning that I was going to challenge fundamental beliefs. That's kind of what I do. And one of my jobs is I abstract white papers. So you can see right here, so Henrik states, boom, most stocks earn less than 1 month treasuries, and 4% of the listed companies explain all the net gains. So this isn't something like it's just my personal opinion. This is hardcore academic research. So I thought I'd show you 3 charts because it kind of leads into the next conversation, which is about rebalancing. And this is where I risk Yas for saying I got boring. So this is the annual buy and hold return for a typical company. And you can see that it's centered around 0. In any one year, for most part, a stock's going to stay pretty much near 0 or up a bit or up a little or not or down a little bit, not much, okay? Very few are going to go up 500% because it's only a year. In 1 year, nothing really happens. And a few, -1 means bankrupt. So if you go -1, it means minus 100%. So in any 1 year, it kind of scrunchy right around 0 because not much happens. In a decade, you can see here that you can have some stocks that go up 500%, but the number that go bankrupt, see how you get that little tail over there right by the y-axis? So it's right over here. So this is bankrupt right here. So in a decade, this is the number of observations. A lot of stocks in a decade go bankrupt. And then a handful of them run away and make large returns. And then this is lifetime. So this is the game you're playing. Most companies bite the dust, and few companies make 10 times their money and just compound the capital. Those are the Netflixes and the Johnson & Johnsons of the world. Knowing that, so we're trying to beat an index fund, we now know avoid the biggest stock, and we know that only 4% of companies are going to make any money, so the probabilities are against us. Lesson 4 is don't rebalance your portfolio, which most of you who, if you have MBAs or CFAs, again, this is challenging a fundamental belief, you've probably had it pounded into your head 2 things: diversify, diversify, and rebalance, rebalance. Is that true? Kind of? Okay. So I'm going to tell you right now, you don't want to rebalance your portfolio if you want to maximize the terminal value. You do want to rebalance. What rebalancing does is it takes your risk and resets it back to where it was in the beginning. Okay, so once you have a portfolio, the risk may wander, it resets the risk. But I presume many of you in the room are thinking, I don't think in terms of risk-adjusted returns. I want to make as much money as I can. I want to maximize my terminal value. That's what that means. Well, if you want to maximize your terminal value, don't rebalance. So the upcoming article I'm writing with this guy, and he's published it before, but nobody really gave it much attention, so we're going to throw it into Institutional Investor and kind of share it more broadly. His previous articles were, he's a PhD in math, were more mathy. But this is, I guess I'll walk away from the podium. So the blue line is if you rebalance. The red line is if you don't rebalance, okay? And as you can see, if you just leave things alone, the red line has more good opportunities. It makes more in the long run. The negative is you go, oh, okay, but Rich, you said that you let your risk get out of hand. Yeah, but interestingly, these are the bad results right here. So anything less than 1 means you're losing money. You can see that actually the bad results are fewer than the rebalance results, which means, wait a minute, you've actually cut off the left tail and expanded the right tail. Now, I know when you're looking at that, you're probably thinking, I don't really get what that's telling me. Think about it like this. If you had stocks and bonds, stocks are more than bonds. We agree on that? If you have stocks and bonds, and the stocks continue to grow, what do you tend to do when you rebalance? You sell some stocks and add to your bonds. And then every year you keep selling some stocks and adding to your bonds. Well, it doesn't take a math genius. You don't need to see a math proof to go, oh yeah, you're right. That would actually cut off, I'd be buying into the asset that's doing poorly and selling the assets that's doing well. And yeah, you're right. That's not letting my winners run, and that would probably result in a lower terminal wealth value. And so that's what that chart's showing. But so many of us have just had it beaten into our heads, you must rebalance, you must rebalance, you must rebalance, that I thought in terms of challenging fundamental beliefs that I would share that in the article and then with you tonight. This is the last thing. So I like to read books, and I actually I like to read from a strategic standpoint. I like to read old books. There's actually something called the Gutenberg Project, which has books that are out of print. It's interesting to read old investment books, like what people were writing like in 1910 and that, because they had some thoughts that were actually pretty good. And when you read the modern ones, I realized, I don't think this is going to work. Like if I'm reading about smart beta, and I'm like, but everybody's investing in smart beta. And we all know that no strategy works when everybody's doing it. And some of the old books have some good concepts. And so I just thought I would share this viewpoint that if you want to learn something new, read something old. This is a book called Graham and Dodd. And this got me to thinking, once I got to hear in the presentation, I was like, oh, wait, I better go back and see what this guy does, because if he responds to me like Goldman Sachs responds to me, this is going to be really bad. But this book, there's 2,000 books about how Warren Buffett manages money, and this is really the best one. It's the oldest one, but it's the best one. If you read the books over time, the problem is that many people look at what Warren Buffett did and they describe what he was doing at that time, but Warren Buffett changed his philosophy a bit. And so, he used to buy strongly based on book value, but he got away from that. And he didn't buy anything with goodwill, but he got away from that, started buying Coke and companies like that. He recognized the value of a brand. And so if you look over time at books about Warren Buffett, they just tend to take a snapshot of how he's doing it right then, okay? This old book actually wasn't quite as formulaic as the more modern books, and it gets into concepts like margin of safety and things like that. And this is probably the best one, and I note here that it's only $6.50 because nobody likes to read old books. Which brings me to this guy. Would you buy a used car from this guy or let him run your money? And interestingly, it worked out well. The presentation, I wrote the article before he actually asked me to give a presentation, but there's a lot of good overlap. So as you heard in his presentation, buying quality companies. And as I noted, in the slide that says, look, very few companies deliver all the stock market's return. This one's on the list, so Microsoft's on the list, Johnson & Johnson's on the list, Alphabet, Procter & Gamble. These are what Henrik Bessenbinder found delivered, this is part of the 4%, delivered all of the returns to the stock market. And then interestingly, this firm owns some of them. And I'm like, bingo, bango, that works. That's exactly, there's a huge value to buying quality companies, because as we saw, most companies don't last more than 7.5 years. So I was like, there's a good fit. That makes sense. Then I went online and I was checking out, what's on the website, and he has the same companies. Other companies aren't on that list, but I would note that Unilever and Henkel here, they're not on the list from Henrik Bessenbinder and Nestle, because that was on U.S. securities. The Center for Research in Securities Prices is predominantly U.S. stocks. So when I look at that sheet, I'm like, okay, out of whatever that is, 10 stocks, looks like he's got 5 that would qualify as big, strong, quality, global growth companies, just like the ones that have delivered all the returns in the stock market over, since the beginning of time, according to Bessenbinder. This is just reiterating what I said before. He's got the accounting health portion. We're trying to buy significantly above average companies, but pay only above average, or pay only average prices for them. All that would fit. All that is good. And then I came to this part, and I like this part too. I was like, to diversify or to not diversify. Diversification's good, but there are very few winners, right? So if you get one of those winners, you want to leave it. Like you get a Netflix, you don't want to sell it because it's very hard to get one of the 4% of the stocks that delivers all the returns. So the one thing you don't want to do is sell it and then go back into the junky ones. And over here we can see that the top 10 stocks represent over 50% of the portfolio. I would completely agree with that. I'd be like, you get a winner, leave it. Do not over-diversify, because that continual rebalancing, like if there's one takeaway from, okay, how do you beat an index? Avoid the biggest company. Don't rebalance, because remember, the index fund itself doesn't rebalance. That's one of the things of a cap-weighted index, but all money managers rebalance. They don't realize, why can't we beat the index fund? Well, You keep rebalancing. The cap-weighted index doesn't rebalance. And that's one of the fundamental reasons that people struggle with it. So a lot of the things here, a lot of the fundamental ideas behind the Mayar Fund actually fit my presentation, which made me happy because, as you saw in the beginning, I got a lot of enemies already. I really didn't need any more. And then I didn't know he was going to cover this stuff, but I was going to say that you can see you've done well. One other thing I would observe is that you've done well, and I think you'll do this, in the upcoming articles a lot on math and diversification. I think you'll do better even yet in a bad market because you've done that well with cash drag, which is impressive, and you've got a below market beta. Anything below 1 means in a down market you're going to do better. So when I look at it, I'm like going, this looks pretty good. And if you get a bad market, I think you're going to do better. So that was my candid analysis of the fund, and I thought it fit pretty well, as it just turned out, into what I was presenting, which, to Abdulaziz's credit, he didn't say he's like, present whatever you want, and I'm like, really, wait, dude, you don't know me. I mean, it might go totally opposite. This could go so south. He's like, no, whatever you want to do, you can do. And I'm like, all right. But it worked out pretty well. I agree with it. It meshes very well with the 5 points that I would share if somebody told me, hey, how do you beat an index? Tell me something I don't know. What are we doing wrong? I'd be like, too much rebalancing, avoid the biggest stock, that type of thing. And so that's essentially my presentation. I don't know if anybody has any questions. Nope. Okay, thanks.
Okay, now to my favorite part, asking questions. This is what a professor do, right? Ask questions. So the way we'll handle the questions, we received some questions by email. So I'll start by asking Aziz some of a question from the list, then we will alternate to the audience and we will go back and forth. Okay? So let's start with the question that we got from the email. Aziz, how do you and your team assess the impact of the possibility of reduced global liquidity on the portfolio on the portfolio's component in terms of valuations and earnings power?
Okay, I just wanted to first thank Richard for doing the presentation. I promise I did not try to influence what he had to say in any way. It's just great minds think alike. But if you have a question for him, please feel free as we go through the Q&A, especially if they're hard questions. I would rather you send it his way. Okay, so on the issue of liquidity, I guess when you talk about liquidity, there are different levels and degrees of how they would have an impact. The most obvious one and the straightforward first degree impact is that if you have a market that has a lower liquidity, you're going to have bid-ask spreads expand, which means that you end up with higher volatility in the short term. Purely from the lack of liquidity in trading specific securities. But that's the easy one, I think, that everybody thinks about, that less liquidity means higher volatility. And so the impact is the same to the upside and downside. There shouldn't be necessarily a bias one way or the other in that first degree. The second degree is that if you do have a market overall that has reduced liquidity, if you do have it also coupled with better returns on alternatives like treasuries or other kinds of fixed income, then you do end up having a negative or a downward bias in this case, because arguably as you have the base, the risk-free rate increase, but you also could have the equity risk premium increase because of the higher volatility that comes from the market. So holding everything else equal, and again, this is when economists say holding everything else equally, you should worry and not believe anything that they say. But holding everything else equal, that would create downward bias to prices. Now, the third degree, I think, which is the most interesting one, is that you could also have the first to feed into the real economy. The easiest and most obvious way they would is through the wealth effect, where it would impact economies where you have a high degree of equity ownership, which is the case, for example, in the United States, which therefore would impact consumer spending. But I think the most interesting one that we think a lot about is that how that reduced liquidity also feeds into higher rates than otherwise for companies, for governments, and how that impacts anything from government spending, infrastructure spending, investment, and all the feedback loop that comes from that into GDP in any country. So the second and third, with many caveats, are on the negative side. And obviously the first one is the most obvious ones. We'll see how it goes, but it's very hard to find arguments where reduced liquidity is obviously a positive. All right, maybe we'll take one from the floor, but if you can please speak into a microphone.
Aziz, what will happen once the unwinding of quantitative easing takes place? If ever really at a scale that could be detrimental to the liquidity in the markets?
I mean, I guess this is again similar to the first question. There's overlap there. A lot of QE has gone actually offline, at least in the U.S. I mean, the most obvious impact that I am also guilty of talking about is how it hits inflation. So there's the monetary part of it, that's the most obvious one. That doesn't seem to be happening. Now, is it a delayed effect? There are a lot of explanations that people have tried to think about why. Well, first you have the increased liquidity and then the pullback from that. It seems to have happened same time that a lot of other things are happening, and when you're doing something for the first time ever and doing it while not having a control to compare it to, it makes it really hard. So when you think about, I mean, for example, let's think of the most obvious thing. When you have the Fed no longer buying treasuries, someone else needs to be buying treasuries, especially when you have the U.S. government in this case expanding its supply of treasuries because they're running bigger and bigger deficits. Well, it used to be that the sell side essentially also bought a lot, even at least as intermediaries, but also for themselves. And under current rules, they're not allowed to buy as much. So we've already seen reduced liquidity coming from the big banks because of regulations since the great financial crisis, and that's global. But we still have seen rates come down. So there is a disconnect. There has been a disconnect between what a normal classic relationship would lead you to expect and what actually happens on the ground. So that's just a very long way of saying I have no idea. But I've personally been humbled not only by the things that I said, but the many things that I thought and have not said, thank God, about it. I think it's a wait and see. What has happened so far makes no sense to me. So, given that, if I go ahead and forecast, I'm definitely going to be wrong about it. Naji?
I don't know if you've seen the later one, the tweet by Robert Schiller, when he said that the housing prices are reaching a worrying level. And this may be connected to the question that we have. How worried are you about market levels and trade war?
Well, there are two questions. The first, let's do the second one first. Trade war. Well, the people who are behind what the trade war don't want you to call it trade war. So that's worrying. I mean, a couple of quarters ago, we sold Expeditors, which is a stock that I followed for probably 16 years until we bought it. And was very eager to have gotten the opportunity to buy it at the price that I wanted. We owned it for a couple of years, it did very well, and had to sell it specifically because I thought that you could end up with things like tariffs. Now we have tariffs. Now you have people going out and people like Trump going and everybody should go and watch Trump yesterday at the UN. It's really funny when they laughed. I think even if they pretended, and I don't know that they actually are pretending, to do things as a negotiating tactic, I have zero confidence in the ability of the people running this trade negotiation to not screw it up. And if they do it on purpose, then who knows? So I'm very worried about it. There's not much that we can do. It's very hard to find, which is a classic problem with any kind of macroeconomic forecast. In order to be able to do something about it, A, you have to be right, which is very hard. B, you have to be different, which is even harder. And 3, you need to be able to express that correct and differentiated opinion in a very clear, actionable trait. And you combine the 3 together, it's very rare that you have that. I think the case of Expeditors, it was very clear, at least to me at the time, that trade war happens, trade goes down, bad for Expeditors. That being said, I'm actually questioning that logic right now. Because it seems that Expeditors being at the intersection of trade is actually doing well, because a lot of the parties involved are not used to things like tariffs and how to deal with tariffs, and so being the person who helps process and make trade possible between countries, they've actually been on the winning side. So while trade will ultimately go down once you have this short-term bump from people trying to buy more stuff before tariffs kick in, they may actually end up doing well, being the person who can help this no longer well-lubricated machine work. So it's very hard to see what you can do about it, except worry. I'm very good at worrying. My wife reminds me of that a lot. But there's not much you can do about it, I think, at this stage at least, other than just keep thinking about it and keep an eye on it. On the second issue of valuation, I mean, I've always said nobody has ever put a gun to our head, or anyone's head for that matter, and forced them to buy an index. It may or may not be the case that U.S. stocks specifically are expensive. They probably are, collectively. The rest of the world doesn't strike me as such, though the history of forecasters on that is almost fully on the mistake in the mistake column. There is still some valuation. Actually, there's still some attractive valuations that we've been able to find, even in markets that we find expensive, because of things like higher volatility, disruption happening in certain industries where the value of the industry is lower than it used to be, but not all of the players are hit the same. I mean, 2 of our top 10 now, Nordstrom and Discovery, neatly fit in that bucket. I would argue, and someone asked about this last year, about packaged consumer good companies like Procter & Gamble, where there's a lot of disruption there as well. And we feel the same about where P&G is positioned within that. So you could have an industry where disruption is causing the industry to fall out of favor, and you can find value within that, even if the market overall looks expensive. Now, that doesn't mean that you're not going to have a bumpy ride, but we believe, and it's part of our partnership principles, to only think long term, and that's where that comes into play. If you can find a situation where there's uncertainty about the outcome in a year or two, but you have very good confidence in how this looks over a 5 to 10 year period, then we're buyers, and this is an example of a situation like that. We have one from the back there. Sorry, you should be the one picking people. You're good.
Since the trade war was brought up, how can the investor protect himself from the trade war, and what kind of effect would that have on public equities, or the public equity market?
Yeah, I mean, the most immediate effect the past several months has been equities that are exposed to trade getting killed. You see it in the German market, for example. You see it obviously in the Chinese market. And in the US, you see it in things like Caterpillar, Boeing, and some of the companies that need to trade. And more recently, you'll probably start to see it more on the importing side of things. That's the most direct link. Again, it's going to be very hard to find a way whether you can either benefit or protect yourself, because the impact is not going to necessarily be one-to-one. Now, if you have a lot of certainty about a specific outcome in a specific industry, then maybe you could do something about it. We believe that we're going to look at every. I mean, again, this is a good time to talk about when we look about on our allocation sheets, essentially. And what we're doing is basically looking at our portfolio every quarter and updating what we think the companies that we own are worth, along with a line around it or distribution around it that informs the downside risk that we perceive to be in these securities. And then we look at the companies that we follow, the ones that we follow very closely, which is basically our wish list, or we call them the bench. And those are essentially, we think about them as portfolio companies with a 0% weight. And then we have everything else that we kind of know, but not enough to actually make a decision on the spot. And then what we do is we try to essentially optimize risk-adjusted return between all of this universe of potential investments. And we believe that by doing it from the bottom up and informing things like trade, informing the risk-adjusted return of specific holdings, then we're going to end up with a portfolio that captures that insight without having to do top-down decisions. The other thing that this does is that there is no minimum number of holdings or allocation in that model. And so if we cannot find enough ideas to fill 100% of the portfolio, because none of them meet our minimum risk-adjusted return threshold, then we won't buy anything. So that's why you see cash moving over time. We, at any moment in time, want to be holding a portfolio that over the next 5 years, from the date that you're looking at it, generates satisfactory risk-adjusted returns. So we're not trying, we show you the benchmark, but we actually never ever discuss the benchmark as a team and when we make decisions. I have no idea what's in the benchmark, what's not, what the weight of our companies in the benchmark is. It never factors into it. What factors into it, do we have holdings in our portfolio that with a high degree of confidence we believe will generate satisfactory returns over 5 years or not? And if the answer is yes, we hold, and if it's not, we sell and let the rest take care of it.
Okay. Can you explain briefly how do you decide to buy a certain stock, and can you share a case or two on how you have done that, and how did it lead to investment decision?
It starts with a dream. I mean, we've talked about this briefly in the process. The most important thing that we need to do, and this started out very early on when I was as many of you know, for many years, almost 10 years, I was working by myself. And so the scarcest asset was my time. And so I learned to say no very quickly. So the goal was, how can I kill the idea in 5 minutes or less so I can move on to something else, because I can't cover everything. Now that has secondary benefits that I discovered later in terms of how it positions your psychology to overcome a confirmation bias. So by tilting your thinking towards the negative in the beginning, as you find things that you like, you're still more balanced than too excited, which is usually the issue. So the first thing we do is we try to use quick tests that we've developed, anything from restrictions on what we can't own, or essentially tools from the mindset of a short seller's accounting essentially rules, where we look at a set of measures, and if a company fails because its receivables are growing too quickly, or there's a good chance of accounting manipulation, or there seems to be some kind of underlying deterioration in the business, then if any of these things combined, we score these, and if we get too many essentially red flags, we just kill the idea and we move on. And if an idea passes that, then we go into the second stage of red flags, which is qualitative, requires a little bit more time from us. And again, this is very rule-based, where we're looking at things like related party transactions, think about management, how they're compensated, and et cetera. And again, we're trying to find something ugly and fishy that leads us to quickly kill the idea. And if we can't do that, then we go into the most important stage, which we call the deep dive, where we're basically diving into the company, understanding the fundamentals of the business, its competitors, its suppliers, the industry dynamics. This stage may take days, but mostly takes months or sometimes years, depending on how familiar we are with the industry, with the competitors, and with the company. And the goal here is really to answer a very important question: is this something that I would like to own at a price? It doesn't have to be today's price, but is this something that I would like to own if it's offered to me at the correct price? And often we reach the conclusion that we have no idea what that price is going to be because it's too hard, and we move on. But every now and then we find something that we think we can handicap, that we can figure out that it's worth somewhere between this and that, and it's more likely to be on one end or the other, and the risks are so and so. And if we can get to that position, then we go and we look at the actual stock price, and 9 times out of 10, the stock price is within that range. And so there's nothing to be done except continue to follow the company, continue to update that valuation, and wait. And every now and then, something would happen, and the stock would go outside that range. We don't short in the fund, so if it went above, there's not much we can do. But if we went below, then that basically allows us to buy. And we need to answer a very quick question at that point, especially if we followed it closely. Has anything fundamentally changed that would lead us to change that range? Because the market is not stupid. The market sells things for a reason, and often the market is right about it. But if the answer is to the negative, that no, nothing has fundamentally changed, that would lead us to not want to own the company, or would lead us to think differently about valuation, then we buy. In terms of example, again, our largest holding now is Nordstrom. So I guess going through that is, actually I don't like to go through existing holdings. So let's talk about something that we've sold. We've recently sold Swatch, and it's been a mistake. So let's talk about a mistake. It's always more fun. So We started buying Swatch, I believe, I'm working from memory here, probably 3 years ago or so. We believed that the product, Swatch Group, by the way, for those who don't know, owns 12 brands. The bulk of their profit comes from their luxury side of brands like Omega. And so a big chunk of their business was coming from the Greater China area, so mainland China plus Hong Kong. But it's a very globally diversified business otherwise. Yes, it's based in Switzerland, but Switzerland is a tiny percentage. And this is a business that earns very high returns on capital, has a product that is very aspirational with massive pricing power. And the thesis was that basically as a bigger percentage of the global population moves through the middle class or the upper middle class, men have one way to express and show off essentially their wealth, and that's by putting a watch on their wrist. The same thesis led us at the same time to buy Richemont, which owns Cartier and Van Cleef and a bunch of other watch brands as well. Now Swatch, being more exposed to China and more exposed to the mid-sized, mid part of the market, had two risks that we failed to properly account for. One was, well, three really. One is China, but China's two parts. One was a crackdown on bribery, essentially, that was happening in the Chinese government, and that did both good and bad hit everybody at the same time. But what it did is that it made it for a while undesirable to buy watches, even for the perception of doing something wrong. But that kind of took some of the volume out of the market. And then the mid part of the market was also hit to some degree by smartwatches, a lot less than what people perceive, but it did get hit as well. You couple that with a downturn in China, and you ended up with this situation where we have a lot of volume that's been taken out of the market. And now suddenly the market is flooded with way too much watches, both at the primary and secondary retail outlets, and you end up with pricing going way down. Now Richemont responded to it in a much better way than Swatch. Granted, they're way more tilted towards luxury. Richemont went and bought a lot of volume, took it out of the market, and destroyed it. And that caused them to take a hit on margins in the short term. And in order to do that, they also cut a lot of employees from their payroll, employees that are very hard to come about. Swatch took the opposite view, that they're in it for the long term, and so they didn't do that. They continued to produce, they kept the employees, they kept the factories running, and so pricing took a lot longer to come back, and in the interim, it was a lot harder for them to control inventory. I mean, we bought way more than we originally owned at the bottom, and we did well on the recovery, but our first purchase determined our cumulative IRR, and from the beginning to the end, it was basically, we broke even on it, which was very disappointing, but that's an example of one. Take one from the floor.
Thanks, Aziz. As a stock picker, I'm very curious to hear your response to the evolution that's happening in the ETF world. ETFs today, there are managers that are not even charging fees anymore. I'm curious to hear your response to this evolution that you're seeing, please.
I don't have it. We talked about active share last year, and it's a very interesting situation. I mean, I'm going to talk about it just from the perspective of the U.S. Mutual fund industry, just because we have a lot of good data there. So Richard talked earlier about outperformance and underperformance and why fund managers mostly underperform. That's not the full picture. There's something very interesting going on there. And if you look at I'll find the study. I'll send it over to you. If you look at the performance, well, first let me define active share. So active share is what percentage of your portfolio differs from the benchmark. And so if you have a very high active share, you're basically picking stocks. If you have very low active share, you're basically just copying the index, and there's a lot in between. And the study went and split mutual funds in the United States, starting with from the 70s until 2015 into 5 groups, 0 to 20, 20 to 40, 40 to 60, 60 to 80, 80 to 100, and looked at how they've performed relative to their benchmark over the period. And then also looked at the distribution of fund managers within the different groups. So are you having more people who have a high active share or less throughout time, across time? Now, essentially, anybody who's in the first 2 group is a closet indexer or an actual indexer. So anybody who has an active share that's below 40 is copying a benchmark, either deliberately or not. And then you have the mid group, and then you've got people who are more than 80% active share, and those are actually going out and picking stocks. It's very hard to do without also having a concentrated portfolio, especially with wide indices. And so what happened is 2 things. One is that people in the high active share pretty much consistently outperform, which was shocking if you look at it. And it's not only is it consistent that the group outperforms, there is a lot of persistence between the individual managers within that group on a rolling basis. So it tells you that they actually know what they're doing, and their stock picking is actually adding value. The problem with the people at the bottom, and then they went and actually dug, is that they do find the top 10 names that they like, but then instead of putting 50% of their portfolio in the top 10 names, they go and they put 10% of their portfolio in the top 10 names, and they go and buy the rest of the market. And especially, and again, obviously, if you look at them as a group, they're going to have to underperform in this case because they are the market. But more importantly, they individually underperform persistently because they're actually not really making any bets. And so if you look at a portfolio that has 80% of its holding essentially in the index and only 20% that's different, the amount of alpha that would need to be generated in that 20% to pay for the active fees is really, really, really high. And so they're essentially guaranteed to underperform even if they picked the correct stocks because they're not actually putting money into it. Now, interestingly, we're more than 90% our active share. So I am very biased here in what I'm saying. So what happened? That's even more interesting story is they've also plotted it across time in terms of AUMs and number of managers. And so it used to be that mutual fund managers in the United States before the mid-80s had very high active share in terms of number of managers. And you see the industry consolidating into the bigger and bigger supermarket type firms being run by MBAs now instead of stock pickers that went up through the industry. And you see active share plummet. And then financial crisis happens, people realize that they're paying for something but not getting it, and indexing explodes. I think if a very interesting number to look at, and I wish someone like Morningstar would just incorporate it, is to take management fees and divide it by active share. And that would be how much you're paying for each unit of active share. And if you did that, you will find that people who you're paying a reasonable fee for tend to do above average. Not always, of course. Some of them get unlucky, some of them are not good. But over time, because you've got also survivorship bias, of course, you're going to end up with a much better group. The biggest driver of loss of AUMs and underperformance has been that move towards low active share. Now, if you think about it from the perspective of the firm as opposed to the perspective of the investor, that makes perfect sense. If you owned 1,000 funds or 100 funds in an investment group, purely by luck, every year one of them is going to outperform. And as long as you don't screw it up on the downside for the other ones, promote the hell out of the ones that did well. The ones that didn't do well, as long as you don't screw up, the AUMs are not going to leave. And so over time, it's a much better business model for the mutual fund families to do that, to hug the index, do a little bit on the side, pray that something gets lucky, market the hell out of it that year, repeat. So from the incentives point of view of these now mutual fund supermarkets, that makes perfect sense for them to do that. Whereas when it was one or two fund managers managing 1, 2, 3 handful of funds, they needed them to do well. So a lot of it is essentially economics catching up with bad incentives. Now, in any portfolio, the odds are, even if you're a good selector of managers, A, you may not see the good managers. B, they may not be open to take your money. And D, let's face it, you may not know them when you see them. And so it's very unlikely they're going to have 100% of your assets, you shouldn't at least, in actively managed funds. The odds are you're not gonna find the people who do it across strategies and geographies and so forth. I think it's a lot more sensible to go for something that's cheap, that's simple, and then when you find someone in a specific strategy, geography, or exposure that you like, you can swap some of that passive for active for that box. And over time, if you're good at it and if you're deliberate about it, you hope over many years that you can find more and more and more managers. You're not going to find them from day one, but over time, you find a handful. And it's through the combination of both that I think things will work out. I think the numbers are very clear. Passive is going to zero. And once passive goes to zero, anybody who has low active share is going to also have to go to zero, which means they go out of the business. And it's essentially the market mechanism working and kicking out people who shouldn't be paid for what they were doing. And then you end up with a market that looks more like several decades ago, where the majority of managers are taking active share. And then we'll see who's good and who's not, but at least you're getting what you pay for. I think for decades, the problem was you weren't getting what you paid for, and you were almost guaranteed to underperform.
Okay. Value investing continues to underperform more than any time in history. Is this strategy simply obsolete?
I thought you were supposed to ask the easy questions.
I'm a professor.
You are a professor, that's right. I mean, Richard talked about smart beta and the idea that you can find something that, I mean, in the article more than the presentation, the idea of a value factor for me, or the value label, that, for that matter, and the most problematic part of it, I think, is in the definition. And when we see people now talk about value underperforming, and it has actually underperformed on a 10-year rolling basis for many, many, many years now. It's been 10 years, the first time ever that it's done that. The way it's defined is by looking at things like PE ratios or price to book ratios. I started out doing cheap stuff, nets, and looking at balance sheets for valuation. I mean, luckily and it is luck, that I figured out quickly that stuff no longer works. And the reason I think it no longer works is that if it's obvious, if it can be programmed into something that you can plug into Bloomberg and have it trade, it'll be traded away. And so I almost, if you show me a stock and I check it out and I see that it's trading at a 12 multiple and everything looks nice, like within 5 minutes, I almost always pass at this point. Those opportunities are gone. If it's simple, a computer would have done it. It's not that the market is efficient and someone else would have done it, the old EMH. But in this case, collectively, again, you're going to find opportunities here and there. Can you build a strategy out of it? I doubt it. I think there's so much capital chasing these types of opportunities. It's too easily replicated, too easily traded for it to be persistent. And so I think a different definition of value will show that it continues to do well. The problem with that is that a complex definition that's more qualitative cannot be captured in an index. So you cannot look at the MSCI value versus the MSCI growth and say, oh, it's underperformed or outperformed. I think value as a strategy captures behavioral biases, and that's why it works. I don't think it's magical or anything. I think we have biases, and value takes these biases and converts them into a risk premium that value investors earn. It used to be that you sold things because, and you could see it in the balance sheet. Now it's more qualitative and it's hairy and requires more work, but I don't think it's gone.
Follow up on this question. Don't you think that the problem is in the metric that we use to measure values? You mentioned balance sheet several times in your answer, but in many companies, like we have a question that I'll ask you later on the FANG companies, for example. Many of these, the new economy, let's say, new economy companies, value creations happen actually in the income statement rather than the balance sheet. All the value creation is expensed in the income statement. So relying on the book value as a value metric doesn't really capture this. So maybe we're just defining the value using the wrong metrics. What do you think?
Yeah, I think that's exactly what it is. I think it's, I mean, it also means things like return on invested capital are also meaningless. At least if you look at capital as measured by the balance sheet. You do have many businesses that essentially don't require any capital to grow. It's amazing from a capitalist point of view. Now it seems to lead to other things in terms of concentrating of power and wealth and so forth. That's not the question here, but I think the old way of looking at value from a balance sheet perspective, and I'm going to say I'm not going to say in all cases, but in almost all cases, is completely obsolete. Especially if you look at it from the balance sheet perspective. I mean, I say that with hesitation because a couple of years ago, for those who've been in the fund for a while, we used to own Silver Bay Realty, which is a real estate investment trust that owned a lot of single-family homes in the United States that had been trading at substantially below, was actually trading below book value, but more importantly, was trading substantially below replacement value for these homes. So more of an adjusted, so it is an asset play in that regard. And it eventually worked out for us very well. But then that one was also cheap because it was doing something weird, whereas yes, it was a REIT, but it wasn't doing a lot of payouts in terms of dividends, so the people who usually buy REITs didn't buy it. And so there was that element of it, otherwise it wouldn't have been cheap. And then you also had no catalyst for the gap to close. Eventually got acquired, so that was the only catalyst. And we had to hold it over, I think, 3 and 4 years, and we got lucky with an acquisition and ended up with a decent IRR. But it could have dragged on for 2 or 3 more years, and our IRR would not have been good. So the problem with these asset plays is that they're too easy to be essentially arbitraged away. And then even when they do work, often the timing is questionable. And the problem with timing is that sure, the stock you bought may be worth twice as much, but if it takes 10 years to double, that's not a good investment.
This is actually for Dr. Richard, please. So you were mentioning in terms of beating an index, one of the classical ways is equal weight investing. So yes, you get rid of the large weight of the largest company, but at the same time you increase all the smaller ones, and you rebalance. 2 of the effects you said were not working. How come you still outperform with equal weight?
So my answer to that would be, in a nutshell, small cap stocks have more market beta. So if you have an equal weight index and you're comparing it to a cap weighted index, small cap's going to win. The issue is there a small cap effect in the sense that you're getting a higher return without the higher volatility? You're not. You're getting a higher return because oftentimes if you try to replicate a strategy and you don't know somebody's in small cap stocks, it looks like they're in equity plus leverage, but they're really not. They're just in small caps. But that's my answer to it. And then Standard & Poor's actually a nice research piece that I'll send you where they looked at equal weight indexes and said, okay, so can we, to what degree is this due to the different components, and can we replicate an equal weight index using small caps? I'm like, yeah, it's just the small cap effect, which is a heavier market beta. So that'd be my answer to it.
Why don't you invest in private equity, venture capital, and real estate? Or let me generalize the question more. Why don't you invest in other asset classes?
Okay. So the way I think about asset classes is a bit different than what a traditional allocator thinks about. To me, a lot of what you just said, the asset classes that you mentioned, I just call them equities. I mean, an equity to me is an ownership interest in a business. And how you capture, this is why, for example, when we talk about our strategy, we talk about buying wonderful businesses, getting exposed to essentially owning excellent businesses by buying the securities of great companies. That's just one way of getting the same exposure. To me, any equity is essentially an interest in a business. Now, that business can be publicly listed. It can be the business of owning a building and renting it out. To me, all of these are equities. And it can be a small startup. It can be a mid-cap or a growth cap, or whatever it is. They're all equities to me. So that is the asset class to me. The second layer is that how do you go about owning that asset class? And some businesses we can own through securities, and we call them stocks, or traditionally people call them equities. If it's in a fund that has a lot of leverage, has the ability to only call capital when it's ready to deploy, and use credit lines to enhance IRR, we call it PE. It's essentially the same thing, just in a different wrapper. And if it's earlier in the life of a business, we call it venture capital. To me, they're exactly the same. And history tells us that owning businesses over long periods of time outperforms other stuff. So I'm not against owning real estate. We just mentioned an example of owning Silver Bay Realty, which essentially is traditionally a real estate just wrapped in something that looks like a traditional equity. What I'm not interested in is owning unproductive assets, like land, for example, or gold, or other commodities. I think productive assets have and will continue to do well over time. They give you inflation protection. They give you a compounding effect that helps you grow that capital over time, and over an extended period of time should and do better than other asset classes. Whatever the business might be, I'd like to own businesses.
Aziz, particularly in the private markets, valuations seem to reward growth. Now, the end of this story may not always be good. And I want to know your take on this. To what extent should valuations reward growth? Where does the music stop?
I mean, I think one thing that's going to be very interesting to watch for people who invest in private equity is that the history we have from the 80s and 90s and into the early 2000s, but especially the 80s and 90s, there was this way of owning equities that people discovered where you buy businesses at a substantial discount to the average market multiple. businesses that generate more cash flow than average, and then you leverage them, and then you do well. And you would have done well even without doing any kind of operational improvements. And the evidence is PE firms don't do much in terms of operational improvement anyway. For the past 5 to 10 years, PE firms have been buying average businesses. They've been paying average or higher than average multiples on them. And they've been leveraging them less than they used to be. I think the next 10 years are going to be interesting to see whether they can actually outperform. And the trick is not whether they can generate higher IRR, because part of that is just the way the cash in and out is managed. So that's a different thing. But can they actually generate a higher investment return on the underlying? And I think it's highly unlikely, I think, that they'll outperform in this environment. But we'll see. I mean, it's going to also depend on what happens to rates. If rates go up and they have to borrow at higher rates, that's going to factor into things. I'm very skeptical about the ability of them doing that. Now, on the issue of whether you should value growth, I mean, that's perfectly rational. In an environment with lower rates, you can have a higher value coming in your DCF from the future. People are just behaving rationally to the inputs that they're being given. I think where people are not necessarily thinking about it properly is that you hear people a lot saying, well, yeah, valuations are high, but that's because rates are low, and so you have a lower discount rate. It makes sense to have a higher valuation. Well, that's partially true, but actually, in an environment where you suspect that rates are going to be low for the next 20 years, you cannot have rates stay at 2 or 3% and still, in your assumptions, assume that GDP is going to grow at 3 or 4%. There's just inconsistency between the assumptions there. People are taking numbers that they're used to, plugging it into their terminal valuation, and then discounting back to today using a very low multiple. But there's inconsistency. If growth picks up to that level in the future, interest rates are going to be substantially higher. The two cannot be the same. So people point to Japan, for example. Yes, Japan had very low rates, but guess what? They also had no growth. So you have to factor that in. And we've modeled this, actually, and we looked at different interest rates environments and what would happen if you actually factor in growth. And instead of the valuation impact being huge, it was a mid to high single-digit impact to valuation. So it's something like 6 or 7. You pay 6 or 7% in a low interest rate environment than a higher interest rate environment. Obviously, forget about extremes, but once you adjust for growth, it makes no sense to pay the prices. So I think a lot of people are going to be disappointed.
How can you claim to be a value investor, yet you own FANG with a AA that have very high PE ratios? FANG is Facebook, Amazon, Apple, and Google.
I mean, we don't own the FANGs. We've owned Alphabet for many years. Like I mentioned earlier, we sold some of it earlier in the year, sold more of it a couple of months ago. Microsoft sometimes is grouped with the FANGs, and we sold a lot of it. Again, we've owned it for 5 or 6 years, and we used to own Apple. Sold it way too early, even though our assumptions on the business panned out correctly. The valuation took care of the upside, despite us being correct about the assumptions. Another lesson to learn. So I think, again, if we're not talking about PE multiples, and we're talking about a reasonable assumption for free cash flows and the growth of free cash flows. When we were buying Google, Alphabet, and every time we've added to it, we were looking at a business that was generating a free cash flow yield to us in the 6 or 7% range and growing at a ridiculous rate, 20% plus. To me, that is very, very, very cheap. To have a business that is a very high quality, very strongly positioned in its market, has massive tailwinds in terms of the industry, yielding a very satisfactory free cash flow yield today and growing at silly rates for a few years ahead. The only reason we sold any Alphabet and continued to, is risk. It's in terms of valuation, I still don't think it's expensive from that perspective. It's the same with Microsoft. It's a bit different in terms of the risk picture. We got the question earlier about ETFs, and one of the things that we've been thinking about and factoring in as a risk factor is how much we've always used hedge fund ownership as a risk factor when we do sizing of positions, but we've more recently started to use ETF ownership as a risk factor when we think about risk. And it's not a qualitative risk factor. It's not a quantitative risk factor. It's a qualitative risk factor that we have to think about. Absent holding everything else equal, again, that scary sentence, holding everything else equal, a stock that is in the ETF, in a case of a massive market sell-off, should be more volatile. We think, we don't know yet, that's just a guess, which means two things. One, from a volatility point of view, it's riskier. I don't really care much about that. But more importantly, it means you may be given a chance. There's a higher chance of you given the opportunity to buy more of it in that scenario, which means take some money off in that position so you can buy more if it drops and own something else that you don't think it's going to drop as much. That's the only, Alphabet is the only FANG that we own. I know it's very popular the past year for people to say that they've missed Amazon, but that's just, value investors started saying it when Buffett said it at the annual meeting 2 years ago. Now everybody has to say they've missed Amazon. The thing with saying I've missed something, it needs to A, have fit within your process, and you making a mistake in applying your process and thus missing it. So while we've missed a lot of things, in the case of Amazon specifically, we don't consider it a miss because we never figured out how much it's worth, and we still don't know how much it's worth. It's a great business, but I don't think we've ever been in a position to put a number on it. So, and we're happy. We've always said if we're not comfortable in having a valuation that gives us a margin of safety, either because the price is too high or because we have no idea whether the price is high or low, we're going to miss some of these opportunities. And I mean, on my desk, I have a sticker that says hashtag no FOMO, no fear of missing out. You have to believe in that. You have to have no FOMO in this business, or you're just going to go crazy chasing the latest fad. Facebook, on the other hand, we wanted to buy twice, and it got very close to our buy price, and we never bought it. So that, you could argue, is a miss.
My question is to Richard, because in the last one, he said, don't rebalance. So what can an investor do when his investments are diverting away from the strategic asset allocation, far away from the margins of the strategic asset allocation? So how's he going to fix that if we are not going to rebalance, which you mentioned in your...
There's no answer to that. So if you don't rebalance, your risk will drift. So just a simple example, as I used, if you do stocks and bonds and you're 60-40 and your stocks grow and you just let them grow, after a while you might have stocks, let's to be extreme, 90. You've definitely got a different risk position at that point, no doubt about it. What I wanted to point out is that it's up to you as investors to decide, are you trying to maximize your terminal wealth? Like if this is play money, then you don't need to rebalance and you can recognize it. And what I was trying to have the takeaway be, right-hand tail of all those stocks that go way out, and you go, oh yeah, and then the same shape in the no rebalance, and that's what you're trying to capture. If this is, for example, not to be trite, play money, and you're trying to maximize your terminal value. but you can't, there's no magic where you can say, well, you know, I didn't rebalance and was there a negative? Well, yeah, in theory, your risk went up. But as you saw from the graph, the left-hand tail doesn't blow out. You don't get this huge left tail, because when the things that are, all assets don't make the same return. That's one of the, oftentimes when you look at quantitative strategies and you read the math, it'll say, let's assume that all stocks have the same mean return. That's a great assumption, but that's not real life. That's the whole point of Hendrik Bessenbinder's research. All stocks don't have the same mean return. In fact, they're not even close. And so when you let those run, even if you pick up a little more volatility, you still have a much bigger right-hand tail. And then to your point, I'm more of a ruminative thinker. I can't think on the fly. With regard to equal weighting, the other thing that equal weighting does, you asked, okay, how does this, you know, why does this succeed? And I'm like, well, small cap stocks have embedded in them more market beta. What I left out is that equal weighting gets a little bit of everything. And so the whole point that there's only 4% winners, one of the nice things when you equal weight, you captured them. You see what I mean? By placing your bets across the board. So when you look at a strategy like equal weighting and go, how does this work? Like, oh, that's in complete conformity with that fact pattern, because you captured them. You bet across the board, you now know you caught them.
So actually we got this question last year in our annual meeting, and we've actioned that item because we've heard that question many times. Starting, I think, April or May, earlier this year, we created the A1 and A2 and B2 share classes. They are identical in every other way to the regular share class that you're invested in. But what they do is that they pay a 2% more or less dividend. And the reason I say more or less is that the board is going to try to smooth that dividend payout over time. So we're going to be using some judgment in how much we pay out. But we've recognized the need of many of our investors in getting regular cash payments. So we'll be doing that 2% a year. And every investor can move between the two share classes very easily. And they can allocate more or less to the dividend one or the reinvestment one, whichever way they want. And over time, they can obviously rebalance if they want to or not. And then by design, the one that pays out a dividend is going to underperform the one that obviously doesn't by the exact same amount every year. So if you don't need the income, I think you should reinvest. But if you do need the income, this is probably a way in helping you get a regular stream of cash flow out of this investment, and hopefully allows you to have a longer term perspective in how you approach your investment in the fund. All right. I want to thank you all for coming here today. It really means a lot to me to have you come here, ask your question. It really energizes me to go back to work for the next 12 months. We have annual reports. We have an excellent book that I recommended in the annual letter. And for those who were patient enough not to buy it immediately, you can get it for free outside. We also have two kinds of chocolate. The black wrapper is dark, the blue one is milk chocolate. It's not one of our portfolio companies yet. But please help yourself. I think we still have more food and drinks to go. We don't like to waste money or food, so please eat and drink as much as you can. Again, as always, you have my email. Drop me an email if you have any other questions. There were a bunch of questions that were not asked today that were asked in the London meeting. The video for the London meeting is already on our YouTube page. I encourage you, if you have nothing better to watch and extremely bored, to do that. There were some really good questions there. We'll be editing this video, and hopefully within a couple of weeks, we'll be sending it out. For regulatory reasons, we have to keep the Saudi video on the password protected part. So you'll get the link, but if you search for it on YouTube, it won't show up. So please don't just share widely. If you're not sure, ask us if the investor is qualified, and then we'll tell you whether or not it's a good idea to share with them. Thank you all. And I'd like to thank Richard and Nadia for helping me make this possible.